What's up, everybody? Good morning. Getting a little bit of a late start today. FOMC day. Let's get ready to roll. All right, I have to cut through this intro real quick. FOMC. All right. I'm gonna make a prediction here. Fed's gonna come in flat. No change. Let's stay where we are. Market's gonna react probably very light. I don't think today's gonna do anything, and I do think we close higher at the end of the week like we have been. Even any sell-off day from here, there's bulls waiting to buy. People can't get in this market fast enough, and bears can't get out of this market fast enough. That's what we've been seeing. Market's looking really good. All right, guys, skip the intro because we're running out of time. Y'all can hear the cool intro song while I'm talking. Love this song, by the way. All right. Russell, rational. Nasdaq, rational. S&P, rational. We're going to look at DD bands coming forward. Good morning, everybody. What's up, money makers? Luigi. Happy FOMC day, Barb. We should get a cake with candles. It feels like it's a day to celebrate. Fed's going to... I think the Fed doesn't need to be cutting rates yet, or on the long haul still needs to raise rates. But we got to pause for a little bit so the employment situation can stabilize. One neat data point, the continual jobless claims last week was a tick down. Something you want to see, that employment's getting under control and people are getting their jobs back. That's an interesting data point that's going to control the labor market flux from people getting fired and not being able to go back to work. I think the Fed is just pausing to not put additional pressure on companies, the banking system and other things. They can accelerate this entire mechanism. Okay, oops. All right, let's get ready to go. Rocket gears up. All right. VIX is still in decay. FOMC day. Nothing's going to really happen. Nothing exciting is going to happen until we get close to the announcement. And the announcement's going to come in relatively flat. So what we're going to do is we're just going to kind of take it a minute at a time here. Get right back. It's kind of cool. All right. Let's get our data coming through. What's up? Yeah, pretty much a non-event. I think all eyes are waiting to see if the FOMC is going to actually come through and surprise us with a rate raise, or just continue along the same path of exhortation. I think it's like a 50-50 shot right now. I'm going to look at the futures information really quick. But, all right. I get data coming through. Let's go. Bull long up, S&P 436 support. I do like it. All right. Cool. Let's go. All right. Looking at this. All right. Let me get the cool lo-fi music on today. Let me get back here. All right. Hang tight, hang tight, hang tight. All right. So BLU 436 support. That looks great for a long. I do like it. What's up, party people? Hit that like button while you're here. Let's chill. Let's get ready to go. All right. We're going to take a look. DD numbers going to come in pretty soon. We got resilience is negative. We got a bull long up. So this is a very, 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 very quick and dirty here and here for this morning. That's not a terrible setup for a quick scalp to then get out of the way before Fed is what I'm going to do. All right. Oh, I got to log into my stuff here. I'm a little behind today. All right. All right, take a look at NASDAQ. Yep, let's look really quick. Q. All right, mean reversion. So as you know, that mean reversion, the minute you go from wall, mean reversion, the minute you go from wall to middle, it is random, and DD typically breaks the tie. So any dip today has this kind of move here for me. So that's basically like a, I don't know, like a one-to-one kind of trade in here. There's some scalping. I take a small position and take that. Now with resilience being below zero, we're going to have, obviously both resiliences are down. So we're going to be selling off today right at the open to bring us lower. And of course that redistribution zone is going to likely be where we start. So everything has support here. Obviously it's a point of no return if we crash through hedge pressure. If I were looking to short this market, I'm going to wait for hedge pressure breaks and let it go down. That's it. So doing that quick and dirty morning analysis, this market is looking pretty interesting. There is no VIX bottom here to bounce off of. No interaction points. The volatility is still in decay. Keep an eyeball out for UVXY to be pressing through monthly hedge pressure. So that's a pretty good setup today. Look at some key stocks we were talking about. Tesla was one of the ones rallying this week. Like I said, nothing until FOMC. There might be some tiny little long scalps up in here to be had, but nothing really. And everything's kind of looking similar. Now, Disney was one of my plays of the week I was looking at. Disney in the monthly map is starting to turn its head towards being a little bit more bullish than not. So things are looking pretty good there. All right. I'll be right back. I'm going to take a quick break and just hang tight while we digest some of this opening data and kind of see how the market does open. All right. Cool deal. All right. So not investment advice, just my personal opinion. Res less than 0. Hedge pressure bounce back up to there with res less than 0. Close out there. Open blue open, but with res less than 0, it's probably going to be tapping that close and supporting the gap down. So keep an eye on DD. Be right back. All right, I'm back. What's up, friends, family? Let's go. All right, let's take a look at this. Looking pretty good. 436 bounce, a nice little recovery play. I think that today that's the trade I want to look for and wait for. Let's see if you have any momentum plays. I'm going to teach you guys how to do that really quick. Come down here. I'm going to go right into the add check mark, bottom left of the scanner. We're going to look for illiquidity pockets here. We're going to look for hedge pusher breaks. Google, I'm looking at my bottom of my screen here. I'm just checking to see how big that is. And how about monthly hedge break? Google is it. So Google's a runner today. Take a look. That's not a good sign. What up? You're going to be starting the trial soon, Matt. Been watching a while, and Rocket seems like such a mechanical way to trade. Really respect that with your health science background. Hey, what's up, Chase? I completely understand exactly. Like, I wish when I started trading, there was a mechanical thing that can get me started somewhere, and that's why you made it. Clearly, my background also in science and engineering is what I studied, and mechanical is something that I have to have, or else I just feel weird. I feel like uneasy, right? If I can't wrap my nerdy math brain around something that's like substantial and is meaningful, I just feel dumb. My brain is like, you're just gambling. Like, why are you doing this? Why not just play the slot machines? Less stress. So I completely agree with you, and I'm glad that you're checking it out. The tool itself, no matter where you are or who you are or what you do, this is the most value, in my opinion, the most valuable information available for the stock market, period. Whether you're a technical trader, a swing trader, an investor, knowing where Wall Street is positioned around you is the most important fact to value an investment. Why would you buy a house without doing the comps, which is the value of the houses around the house you're buying? Why would you invest in a house called Google without knowing where the neighboring houses investors are as well, right? The investments, the value of everything. To me, this is like comps for the stock market. How do other people value Google? Okay, well, clearly it's bullish at 123. Clearly, we're creating an effect where there's a monthly hedge break today, which is downside momentum inside of an illiquidity pocket. So this can get violent pretty quick. So to me, that was just so valuable to have something of substance, and trying to find this out there before. When I started trading back in 2010, there wasn't a lot. Everything was technical analysis, and there wasn't a lot of vendors creating new techniques and tools. In the last 5 years, there have been so many different types of analysis spawning up, which has been great. The variety's gotten better, which I love. So be very careful Google today. That, oh, looks like. So I'm glad that you are checking us out. All right, make sure we put this up here. All right. Mechanical is something that a new trader struggles with, because it's hard to be mechanical when you have to interpret indications, right? You'd rather have like an autopilot it's like something that's consistent. I say an autopilot, let me think about it. A rule set. Like if the rule set was like, here's your indicators, good luck. Which time frame do I use? How far back do I look? How much historic data do I need? Which support and resistance do I use? There's so many open-ended questions. It's like you're handing somebody a very complex tool like an iPhone, and then you don't just open the box and it works. If you had to open the box and you had to program it, set it up, configure a billion things just to get yourself to be able to dial it, people wouldn't have liked that. The idea that you open it up, it's already even charged, just turns on, and it's ready to go, and you put it next to your other phone and it transfers everything for you. to me, that's what I call mechanical. It's simple. It's simple to use, I think. And that's what our drive here is as well, to make it simple to understand and use. Simpler, at least, as the years go by. So appreciate you guys being here. How can we check the sector for Google? Yeah, it's good point. Let's go. Hold on, let me do quickie news. Yeah, you're right. See, look at these people checking me, making sure I'm doing the right stuff. I love it. All right, let's see what sectors are looking great. So materials looking good, industrials looking good. We had some data come out this morning. Make sure that we take a look at that really quick. The core PPI came out. You know, these numbers came out kind of a wash. The year over year, May came out 2.8. Not surprised there. This has to do with pricing of goods sold by producers, right? So that's the perspective of the seller, right? So that's on the high end of the logistical chain. And of course, that number's just been coming down. So clearly, there is throughput logistically, like so demand is going up against supply. I guess I'd say, well, actually, no. Prices are coming down. So the cost of production, this is PPI, sorry. Cost of production is coming down. Wages are coming down. So they're selling their goods lower to incentivize people to continue to buy them. Easy as that. Okay. Sectors, let's look at today. Communications. So Google is, look at that really quick. Meta's looking good. Netflix is looking good. A lot of the communications looking pretty solid for the big hitters, and that's very moving very little. So let's do XLC really quick. Keith, where do you start off? Where do you short? Okay, where do I short on mean reversion? If I were ever to short, so XLC is trading above monthly hedge. That might keep Google in check for a little bit. Keep an eye on 64.25. So mean reversion. Let's see. What was it? QQQ or SPY? Or Google. Let's find something that has that. Okay. So first of all, when I decide to short, I always have to short on something to something. Anytime DD is bullish and we're in mean reversion, my brain always tells myself that two things. Mean reversion on its own, liquidity map likes to maintain the balance. It likes to bounce off the wall and go to the middle. The minute you touch the wall and the minute you touch the middle, it is random from there. It's completely random once balanced. When the market's balanced, now the index, I use DD to tilt that balance to say, well, it at least wants to touch the upper bull zone before the bear zone, because why would the S&P be bearish if the stocks are bullish? So DD doesn't control an individual stock. So the index, I wouldn't be shorting at all unless there was a reason to. I have to short off of something to something. So if the distance from wall to middle is enough for risk to reward scalp, I would take it. But I personally don't take shorts against a really strong DD. If I do short, I can short through the redistribution zone because those are quick ins and quick outs when resilience does drop below zero. But even today, it's not below zero. NASDAQ maybe. So say, for instance, Google's short would have been from here to there, and that's not a lot of travel. I wouldn't have taken it. So mean reversion shorts are not something I typically do. I only short, again, be very careful. When markets move up and somebody's like, well, maybe I should short it because I think it's going to come down. I always short for a reason. I don't just say it, but the mean reversion short on its own is the upper wall to the middle, and it must be closed at that point in general. And once it happens once, it's over. So Google, it's done. That scalp took place right at the open. And as you see from here, it's random. So a different mechanic comes up is that if one were to be bearish on a stock, breaking monthly hedge pressure is a bearish reversal mechanic. And remember, monthly hedge pressure is monthly options that expire to Friday. So inside of here and here, there are other mechanics that can create momentum. Scalping short from here. And again, this is not investment advice. I'm just answering a generic question about shorting. Here to here is a scalp. Here to here is a potential bounce. But if you do break here, this is an illiquidity pocket, and they move really fast, as you see. Illiquidity pocket is where bear zone is above bull zone. It's the opposite of mean reversion, or liquidity pocket. So the interesting takeaway from this, and I'll give you guys a little tip on this one. Bear zone above bull zone. You have to think about people that are long and people that are short. In the middle of this orientation, longs are losing. Put a frowny face. Shorts are losing. Yeah, we're all losing our trades. In this environment, though, in the middle, shorts are winning and longs are winning, right? We're all winning. Everyone's winning to the house. So liquidity pockets love the middle and will hold there until people exit. Illiquidity pockets hate the middle and will try to get out of it as fast as possible. As you see right here, it doesn't want to hang. It wants to get out of the way. Everybody's winning. Bulls are willing to be bullish. Bears are willing to cover. So once the bears go, pretend you were short right here and the market's been rallying and all of a sudden you're now green on your trade. Oh, thank God, let me get out. Whew, whew, got out of the way. And that covering brought you right back out of the zone, right? Once people go in the money on their trades that are upside down, they're willing to exit. That's what illiquidity pocket tells you. When everyone's winning, well, the weaker side's going to take profit. And the weaker side is the bear side. So in an illiquidity pocket, bears are going to be ready to get out of the way because they're being overwhelmed by the bulls, 90% of the market. Pretty cool how that works, right, Keith? Imagine you've been short Google forever, and then all of a sudden today you get this nice little dip. You're like, oh, thank God. This bull market, I'm green for like a minute. Whew, cover. And that's exactly that mentality. That's what you see, right? And that's what's going on. So illiquidity pocket and liquidity pocket are both something you have to understand. LPs, I don't like to trade unless there's a real reason to, like the distance is long enough. I don't want to trade a balanced market that's not bullish or bearish. Instead, I'd like to long the market on the bull break on hedge pressure, or short the market on the bear break like that. As you see, there's momentum here because of the illiquidity pocket. It's going to want to push out of the zone very quick, and you can see that rapid move like that. Liquidity pockets are going to be balanced, flat, choppy. If you buy puts, you buy calls, you're just going to drain theta all day long, as it's not going to find a lot of momentum in here. The mechanism for momentum in here is very easy to see. So one of the tricks is to search for illiquidity pocket and hedge pressure breaks to find that mechanic that makes a runner happen. Everyone understand? So LP and IP, the main difference is when the bears are on bottom of bulls, it's liquid. When bears are above the bulls, it's illiquid. And that's it. We've been making a lot of infographics for the Discord. You guys can see that there's a lot of new stuff that'll kind of detail all that. Everybody, make sure you do me a favor, really quick. Hit that like button on the stream, dropping some knowledge bombs for you. If you like Rocket Scooter, if you want to check out the extended trial, $35 a month of the entire platform, lock it in while you can. We're about to have live trading open up for futures in about 2 weeks. Connect your futures broker and trade live through our platform to any broker of your choice. And then following about a month after that, we will have live trading to most U.S. equities brokers and options brokers as well. You'll be able to live trade one-stop shop in Rocket Scooter. I'm so excited. Been working on this for a very long time. I'm ready to open that up for you guys. So we're going through our testing right now of most of the features, logging in, getting data, getting contract data, displaying candles, all of that stuff, testing it all at once, building it, testing it, building it, testing it. It's looking good. So $35 a month for the $199 a month platform for 3 months. You can check it out for 3 months, see if you like it, and I promise you a cool little thing. If you catch a little pop-up on your platform that says, hey, check out this deal, you can lock that price in forever. Whatever you pick is yours forever and it'll never go up. We're doing this like launch thing to really celebrate and let our member base lock in like a founder's rate. So like I said, anytime a new gym opens in your city, like Solid Core opened up down here, Nicole went and signed up at Solid Core and got like, it's going to half price monthly membership. It's a Pilates thing. Started taking me to that. I work out a lot. And I was like, oh, cool, let me get a membership. And they're like, yeah, $225 a month or whatever. And I'm like, what? How'd you get like 100 something bucks? Well, actually, like I signed up when the studio opened and I locked that in forever. I'm like, damn it, founders rates. Urgh. So that's what we kind of wanted to do. And so if you take those pop-up deals and lock in that price, it will stay that way forever. And you guys can have a cool founders rate to brag to all your friends. So you have to pay $200 and you come in very low. We want to make sure that we had an affordable platform for people to use. And of course, the full education bootcamp comes with that and access to all of our tools. We are making infographics to explain a lot of our phenomenon. As you can see, DD Float is something we released last night. Infographics we think are going to be very helpful for analyzing and understanding what's actually going on. Clearly, this is a fun explanation of a futures tracking mechanism to DD Float, something we talk about all the time. This was released last night. So every day we're going to be building more infographics to explain a bunch of our tools. One thing I'll let you know is in the curriculum, we have restructured how it works. You're going to see there's a summary and pretty much a summary in one video for each of the rules now. We had a bunch of deep dives, and the deep dives are now in extras, and extras is Pro Plus. If you guys upgrade to the Pro Plus, like with the pop-up deal, you'll get all the extras and deep dives. DD Bands has like 6 videos, but in the boot camp, we don't want people to bog down on one tool. So like in risk management, you have the 2 videos and the infographic, 2 videos, infographic, 2 videos. And the summary is just like a 5-minute thing. So I hope you guys like the new layout of how we're doing everything. The cheat sheets are killing it. Good. That's what I'm hoping is very helpful to keep people from being like overwhelmed and lost. Quick video, medium dive video. Here's a cheat sheet to go with it. And the platform tutorials, the cheat sheets will all be located in one spot, just like this, with the new infographic for liquidity maps to come with it as well. So we're gonna have an infographic pretty much for every video. That way you can like have a compilation of all your stuff. We're not even make like small, like 2-page or 2 per page book that maybe you can print out. And maybe I'll try to make a black and white version so I don't kill your printer ink if you want to print this out in color, because this is blue in the background. So we can make a printable version as well. Serious question, but I don't mean this to be negative. It's not negative. There's no such thing as negativity in the stock market. Everybody's positive and cheerful all the time. When you grow and become more and more known, do you think that market makers will try to figure out your platform? It doesn't matter if they do or don't, because what are they going to do? If they change their behavior, we change our analysis. We monitor their behavior and print their positions. How are they going to hide their positions from us? It's inescapable. It's undefeatable. Nobody can. The more people, as we get bigger, there's nothing they can do about it. They hedge their positions the same way, delta and gamma, but they can create a more complex hedging strategy than that. That's exactly how hedging works universally. Their positions are what they are. Opera gives us the data. They can't escape the visibility of Rocket Scooter at all. Regulation require them to give us the data. They have to report to Opera. Opera gives us the data. We look through and we know their patterns. Now they can change their patterns, but why would they do that? Even if we have 10,000 users, we have 4,000 accounts now. We've had 10,000, 20,000, 50,000. It's still a drop in the bucket compared to how much money is exchanged every day by banks and institutions. There's no counter to what we do. They'd have to not delta hedge, and they'd have to do something different. How would they do? They'd have to go hedge somewhere that's not options. They have to go. It's as long as options exist, I ain't going nowhere. We have that discussion all the time. When you come up with an analysis tool, like dark pool is the same thing. It's not defeat. It's you can't defeat it. There's companies that do dark pool analysis, like black box stocks. What happens if everybody's looking at the dark pool data and the tape reading in real time unusual flow, or the market makers account? No, that data is visible. There's a window that allows retail to see that forever. They can't escape that window. You must report dark pool activity within a certain amount of time to order. Regulation changes is the only thing that's defeatable if regulation went backwards and said, it's okay, hedge funds and asset management firms, you no longer have to report your positions to the options authority. Then what happens? Then the market becomes a cesspool for fraud and money laundering and usually and people insider trading. The reason people are forced to report their data and information is to prevent insider trading. Imagine if you never had to report your options positions to any government authority. Then your job would be to become golfing buddies with every CEO of every company and then go become a quadrillionaire, which is a real number. You just buy options outside the visibility of the government and market. Fortunately for us, Uncle Sam doesn't like people to hide money and escape taxation, and the regulatory bodies don't like people to get an unfair advantage in stock market. They're never going to allow that to be invisible. Thank God for us, right? So at the end of the day, we talk about these kind of ethical dilemmas all the time of what would happen if, you know, as transparency becomes available, technology spawns on the foot of transparency. The institutions can't change their behavior. Delta hedging is as mathematically precise as you can get. Gamma hedging and other Greek hedging. As new techniques are invented, clearly we will discover them. As new visibilities are there, we will exploit them and buy those data feeds and figure out ways to use them. As regulation changes, like we will modify our activity and create new tools. As zero-day options become a thing in the SPY as of late last year, we had to create a new rule on top of that. Don't trade after 2 p.m. Why? Because every day is an expiration mechanic. So every day is going to have random movements. So the idea is that when things change, we change. And it's a game of cat and mouse, right? Or it's cat and mouse. It's like when a drug-resistant bacterial strain resists the drug, then you create a new drug. Then they resist it, then you resist their resistance. They resist your resistance. And you're constantly space race with technology. And we've committed to always one up and the one up. Yo, yo, yo. Smash that like button. Yeah, so the idea that options position will always be reported, A. Okay. B, that options data feed is available. It's always been available and will always be available to technology providers because that funds Opera. They make money selling that data feed. It's a huge revenue generator. They would have no incentive to not sell it. I'm just thinking of all the angles, right? Market makers could counter their knowledge by trying to hide their data or delay their data further using dark pools and other things and kind of skew the data a little bit. They'll discover clever tricks to escape reporting, maybe. Who knows? That'd be kind of a big no-no if they did anything black hat, but you know, there's always people figuring out loopholes and ways to get around stuff. So the only really counter would be is that if those that hold options weren't truthful in their reporting, or they found a loophole to delay their reporting further or hide their position or cleverly trade a complex trade that wasn't direct and easy to see, that we escaped our visibility. Like for instance, if every single time they had to have a share imbalance on SPY, they went out there and actually bought options in all the stocks just to kind of blend it in a little better instead of directly buying risk in SPY. That would be a very complicated process. I don't think they would go that route, but obviously the SPY hedge pressure would be off if they weren't hedging SPY stock with SPY options. They kind of have to because they need that stock to exercise those options anyways. Kind of forces them to stay internal, which is exactly why we don't do liquidity maps and futures. The trick is that SPY options allow them to buy and sell SPY, and people that sold those options are forced to buy and sell SPY to the options, the purchasers of the options, if they exercise them. So they have to have shares of SPY, so it forces hedging to stay internal. And so by design, using liquidity maps on ETFs doesn't allow them to go out and hedge anywhere else anyways, because maybe they'll hedge their risk, but they don't have the shares in case that option gets exercised. So that keeps them from going out and spreading their hedging all across the market anyways. So that has a self-protection on it. Well, let's try to think of like the ways it can be defeated. They can change how they hedge. So our hedging models, that's very key ingredient to hedge pressure. How do dealers hedge their positions? How do option sellers hedge their options that are sold? A market maker is balancing their risk to neutral. Well, you assume neutrality, and if you identify a market maker option, then you can use a combination of Greeks to create a neutralization model. Now, our neutralization model could be wrong, which would skew hedge pressure. Bull and bear zones won't change. That's positional data. Hedge pressure is determined by the hedging model. If hedge pressure no longer starts providing high volume pivots, then we'll just know to adjust our hedging model until it links back up. But that would require new pricing methods for options, but Black-Scholes is a mainstay. And Delta and Gamma and these Greeks are what has been used since God knows how long, 100 years. So I don't know, Black-Scholes probably came out in the 60s, 70s. I can't remember exactly when. But there are new options pricing models that come out that are more sophisticated, but they still run along the same lines of probabilistic options pricing based on probabilities of striking in the money at a deadline. They're just more sophisticated, but they have the same premise as the underlying goes in the money further. The rate at which that option's neutralized and priced correctly is based on one of those models. Those models are very similar anyways. Way to pull up multiple ticker charts at once, Rocket Scooter. Yes, you can. You click this button right here. Pops out a new chart. Put this chart anywhere you want. You can keep popping out as many charts as you want. Pop out another chart. This is opening up a different screen. You can build a 4x4 grid, an 8x8 grid. Anytime you want to save your layout, click this button right up here. This will save your layout and remember all your selections. Cal. Why don't I start doing that on my screen? Because I know I like to look at different things at once. Let's go XLC. Or XLK. Let's put up something. Okay, XLK. Let's do that. Let's go ahead and... This is such a cool picture. Okay, let's go ahead and build like a multi-chart. Like it. Oops. Double checking. Why didn't I think about that before? I mean, that way people can say, oh, yeah. So I'm not doing any trading until FOMC probably, so I'm not going to do much until now. And you just click the, so you can also pop out the scanner. Anything that has like this, you can pop out the scanner. Have different versions of the scanner. You can pop out these little resilience charts. Which I think is really handy. I do like this. Let's remove resiliences here as I already have them. Let's get creative here. SP resilience. And I'll save my layout like this as well. Just have fun with it. I don't like when this auto... Windows, don't tell me what to do. Gorgeous. Beautiful. I'm not gonna lie, I love our color scheme. Color scheme is fun. I think it's dope. I'm not gonna lie, I love the color scheme here. DD, let's go. Let me just save the layout. Okay, good. Well, from what you gathered, it appears that when market makers get caught, offsiders are repositioning it open. Your platform is constantly updating to alert changes. There you go. That's it. So when somebody, like this morning when somebody was saying, oh, that was you actually, like, where would I short a mean reversion? In the liquidity map alone, remember, any position I take, I have to look at all angles, right? So in the liquidity map alone, you can see that in a mean reversion, if there is a short, it's from bull zone to middle. Now we're redoing the liquidity map, by the way, to make it also match the colors of the platform. From here to middle is typically what I would do. So anytime I try to do any kind of a trade, I have to map out all the pieces and what's required. So let's do an example. Like Google, a bull long up is open, blue, open. I think that's where we open like that. A liquidity map of a liquidity pocket is pressed to the middle, okay? But note that anytime you bump into resistance, you have to take into consideration. So I always kind of draw like this. Okay, no resistance there to the middle. Here, sticky resistance, then the middle. And you can see sticky resistance, then to the middle, right? So all the pieces are in play. A bull long up, if you support at the open, you push higher to another resistance, which will be here. And of course, if the rest of the stock market's filling its gap, you can always, you know, make the assumption that if you want to trade a stock individually to fill its gap, you can do that as well. So I try to piece all the pieces and I have to say, okay, if I were to short something, where would I short? Well, this is not really that much travel compared to what can go against me if I'm wrong. It's less than 1 to 1. I don't want to take it. I look at everything else. DD very positive. Okay, well, most of the stocks are not going to be trading down unless there's a reason to. So I have to say, well, does Google have its own mechanism to trade down? Is there bad news in Google? No, not today. I didn't hear anything. And it's Fed day as well. So for something to crash on its own, it makes very little sense. Most things will snap into place with like a 92% DD. Then most things are going to end up in their bull zone if you're in the middle and in neither zone. So the tiebreaker from the middle of the S&P pivots the S&P up. So I would watch the S&P to see is the S&P pivoting up and Google's in the middle. If the S&P is going up, then Google may just be just trailing along with it, right, with no mechanism. So as long as stock doesn't have its own reason to move, I tend to think that stocks in the index all line up when DD is very strongly bullish or bearish. They'll all kind of trade together. So where would I short? That's a good short. Well, I'd have to short on a monthly hedge break, but it still bumps into 122 because of the mean reversion setup. Oops, this actually is from there. So it'll be sticky here, and if it falls, there's a illiquidity pocket that's likely to support back up. Because again, all the market's very bullish. So the bull support typically is in play. So DD being bullish has two different thoughts, right? It either escapes a bear zone and goes to bull or supports at a bull zone. Either one of them is a potential. So the only shorts that really make sense are like a leg like that. And as you see, it's very short-lived. So I look at all the pieces together and I say, well, I don't want to scalp this in the middle. That's really not making any sense. I can long from here to the middle. I can long on the breakout to fill the gap. I can short from here through the illiquidity pocket and come down. So in reality, the only place in Google I really would want to do, I wouldn't want to long on a hedge pressure break, so let's eliminate that. So my question is either I short from there, I long from here to there. So I short from there, cover there, long from here, exit there, or long from here with a stop. Actually, long from here with a stop to bet that we break through and keep going on Fed, right? So very, very, very small long like that. So now I've eliminated like what doesn't make sense because risk and reward's kind of booty. So let's get rid of the mean reversion. So as you see today, scalp, 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 right? And it didn't even go all the way down. But it like I said, that's what I would be looking at, right? Just like that. All right, y'all. Okay, let's take a look at SPY today. Looking good. Let's find an upper target. Gap fills. We have a bunch of gap fills waiting to come. 451. That's way up there. NASDAQ's already filled its gap. There's another one coming up. So that was yesterday. I don't usually do any trading leading up to Fed. If there's a scalp like in the morning, I get it and I'll take it, but usually don't do much. Bad day. some of the data points coming through this week. Just kind of chiming in on a little bit of CPI data. Everything's kind of on target to fall under control of, you know, what the Fed's trying to accomplish. The jobs market's looking good. CPI is continuing to come down. You know, the year over year is coming down, and we're actually beating expectation, which is great. So it means that inflation's coming down. Now, again, it's not necessarily the rate hikes that's doing it. The rate hikes created bearishness in the stock market. This is an indirect control approach. To control wages, all you have to do is scare the stock market and make the stock market sell. When companies are being stupid with their money and hiring people to sit on a Zoom call once every 2 weeks to actually pay their job, pay them for a job they don't really do anything, you slap them in the face by crashing their stock. All the Fed has to do is raise rates just enough to scare Wall Street into, you know, a bear market. And QT, scare them in a bear market. And then companies go, ooh, shit, we weren't even paying attention to efficiency. Markets at all-time highs. We're being frivolous with our money. Well, let's sit back to the drawing board and really think, okay, let's finally analyze the, oh, shit, we've got 10% of our workforce we can actually let go and maintain productivity. All right, well, let's let them go. A bunch of people got laid off. Wages came way down. Job market got saturated with unemployed people. Couldn't get a job back. And then the desperation of people to pay their bills finally were like, oh, man, I doubled my salary during COVID because that's what was going on. And now I was being a greedy worker and I want my big double salary back to pay my big inflated house price that I bought during COVID. And companies are willing to do that for a while now. They're not. Now people are now desperate and getting back to the place of, okay, I'll take my original salary. Oh, you won't even give me that? You're going to give me less? Oh, crap. Okay, well, I do need a job, so I'll take it. That's where we are. That's exactly what happened. So people are now going back to work at lower wages. And inflation is just plunging because of that. The cost of goods from the producer side is coming way down because the cost of labor is coming way down. How do we know that? Well, that is today's data. Core PPI month over month, year over year. PPI. So PPI first. The change in price of goods sold by manufacturers from the manufacturer's perspective means the cost of manufacturing is coming down, which is the cost, means the company's becoming more efficient after layoffs. Thankfully enough, this is the mechanism that kind of slaps everyone in the face and says, okay, the cost of production is coming down. Therefore, inflation is coming down as they can sell their goods cheaper to maintain throughput, because wholesale orders are down, because retail providers aren't selling stuff as fast, or retail outlets aren't selling stuff as fast. You can see that in other data points because of the recession, because people that are unemployed, there's a secondary issue. Yes, you bring wages way down, but also after enough time, an unemployed person is no longer spending their money either. So they're not buying stuff, so commerce freezes on the downside. We've controlled the upside now, like the front end of production. Productivity is high, more efficient, cost of production is coming down. But now warehouses starting to stockpile with expensive goods that outlets now have to say, well, we bought this stuff when it's expensive and we got to still sell it, make a profit. People aren't buying it because you laid them off. They're not spending their money. Now we're stuck in a different logistical bottleneck. And the wholesalers, people aren't buying this stuff, pallets of these things anymore. And so the producers are like, well, we got the cost of production down. How about you continue to buy? We'll just keep lowering the price. That way we can keep producing and you could keep buying, so you lower your price. And so companies will have to say, well, let's take a hit on the first couple pallets because behind that, they're selling their stuff for cheaper. So let's go ahead and lower our prices. This is going to pressurize the Walmarts and Targets of the world to start lowering their prices of things so they can continue to buy the cheaper manufactured goods, because maybe the stuff they bought way back here is still sitting on the shelf and they got to sell it at a loss to finally sell the stuff to make a profit. This is the, like in fashion and things like that with high turnover, that's going to correct itself really quickly. But for like physical goods that don't expire, like toasters, right? Toasters can sit on the shelf for 3-4 years before it gets replaced. Like a t-shirt will stay on the shelf for like a season and they got to throw it out. Things that have high turnover will have this problem fixed. Things that are like material goods, technology will probably turn over quicker. Other static items like, I don't know, towels, coffee cups, stationery, all like those things will sit there forever. And so the downside is that big box retailers are gonna have to start selling things at a loss to buy the cheaper stuff to sell it again, to just continue that throughput. And it's like prices are coming down, we're hitting a new bottleneck. And so the Fed has to stop pressuring the market so that we don't continue firing people. They have to pause because they can't threaten the market too much and they can't threaten things too much. Inflation's coming down, problem solved. This is coming down because we fired people. But we fire too many people has a reverse effect. That's fewer people buying stuff and the commerce freezes up again, just like it did in COVID. People don't make anything, so there's nothing to buy. You have shortages. When people don't buy anything, then everything freezes again, and then producers got to lay people off because they can't. Warehouses are full. Wholesalers got full warehouses. They're not going to buy pallets of your things anymore. You know nowhere to store them. So you got to lay people off again, which accelerates the problem. So Fed has to drive a very, very, very thin line, essentially drive layoffs and lay off just enough people to force companies to be efficient, lay off their bottom 10% of the workforce, and lay them off just long enough to where they're desperate to take a lower wage, but not too long to where they're no longer spending money and buying TVs from Costco and stuff, right? You want them to get fired for long enough that they're willing to accept a lower rate. But what happens there is that you start pressuring the things they bought at a high price and now they can't afford it, like houses and cars. So when you have that effect, the Fed is going to have to face potential default of certain class of investors or borrowers who borrowed at a high rate. And it's not a lot of people that were in that situation who bought the house in the middle of COVID at double the price. You know, those people are going to get screwed. But thank God it's not systemic that everybody's in that boat. Because for every person that bought a house at a high price, there's somebody that sold a house at a high price. And if they lost their job, they've got money to spend. So it kind of is like self-correcting. So the outlet is that Fed has really, the market's going to self-heal from that mechanic. And so it's like, as people get laid off, is there risk of defaults? Is that going to crash the housing market and all these other credit markets and such? Well, banks already crashed this year, didn't they? They crashed under the weight of collapsing crypto. Well, remember when the banks crashed under the weight of collapsing internet in 1999? This crash, we survived. The bubble that popped, we survived. So in reality, there is no bubble to pop. The stock market's not going to crash. The Fed is just slowing down to give the market some time to monitor the effects of what they've done before they decide to speed up again. And I believe by the end of this year or next year, we'll be raising rates very aggressively. I think we'll go to 10 to 12% and probably stay there for half a year to a year and then come down after the recession's over. And I think the market's going to rally while they're raising rates. It's going to be just like 1984, 1982 again, where rate hikes are not going to be enough to stop a bull rally. And I think that at that point, once people start going back to work and companies have reinvested in their efficiency and AI aids that, we're entering a new era of the workforce where the cost of labor is going to become infinitely cheaper as companies turn more to AI and optimization. So people are going to be in a really, really, companies are going to make a shit ton of money as their efficiency goes up. So they're going to have the ability, the problem is that if jobs get eliminated due to the robots, then that's, how are people going to make money to spend it on stuff? Interesting spot, right? Let's look at IWM. Point I'm saying is that the Fed is going to pause. This whole talk is the Fed's going to pause today Fed's going to pause. They're going to pause. Were they going to cut rates? It's possible. But the only thing they would do to cut rates would be to stimulate lending. And you're not going to try to stimulate lending for any reason other than to rescue banks and increase commerce. And if you see commerce is going to increase on its own as price is lowering. So inflation's under control on its own. There's no reason to cut rates to create inflation again, right? Where people will go out and borrow more than they can afford and overspend. That creates inflation. So they don't want to create inflation. So I used to think they would cut rates, but only as a mechanism to stop a market crash, to kind of incentivize Wall Street, right? Oh, they're cutting rates. It's all become bullish again. AI created that effect. So I think that was a bone in the universe through the Fed, because the Fed was kind of toying with the idea of cutting rates to prevent a market crash. Now they don't have to do it. As a matter of fact, the strength of the rally on its own can create that bullishness without Fed having to cut rates, which means it's got resilience in case they do raise rates to not become very bearish. It's really interesting how the stock market's going to outpace the recession. And we're going to see that for a while. The stock market's going to be trading bullish and go to highs. Nasdaq might break all-time highs, and we're still going to be in a recession. This is going to be a very mild recession, by the way, everybody. This is going to, like, I've been through a bunch of these. This one's not going to be bad at all. This one's going to be very quick. It's not going to be like loss of asset value like 2008. It's not going to be like a quick V-shaped recovery either. The recession is going to be a gentle decline in the market without a crash for many years. And we could be flat for many years as well, unless there's some kind of boom. And this AI boom could be the answer to that. So my thought is the recession is going to be very mild, and very few people are going to feel it. As a matter of fact, you might not be feeling the effects right now. Questions. Can you explain liquidity on SPY and the numerous bull and bear zones between monthly hedge pressure and hedge? That's what happens when you get close to an area of high differing of opinions. You start to get differing of opinions sometimes closer to monthly expiration, which is Friday, or FOMC day. You can see that there are people literally all over the place on FOMC. Big decision days tend to have a lot of discrepancies. Louis says he agreed with the rally even through the hikes. Yeah, the hikes are going to, like, rate hikes will provide like knee-jerk sell-offs that bulls can't wait to get in and bulls can't wait to cover on. So, like, the idea is that in 82 to 84, you started to see like the rate hikes would create dips, and then they stopped making even dips to buy. And that's kind of what the Fed is doing, is the Fed needs to allow the market to recover on its own and the job market to recover on its own due to just the efficiency and the mechanics of all this logistical chain we're talking about. And once that happens, then people will create, commerce will improve, and then companies will make money and earnings will look great, and the fundamentals will look great, and nobody's gonna give a shit what the Fed's doing. Because if the stock market's outpacing inflation, people are going to be long the stock market and not sell stock. And the stock market will rally and people get their jobs back and economies healed. So the stock market outpacing inflation by any mechanism is the reason people go long. And we've been outpacing inflation in the stock market since early this year. Inflation's sitting at what? 4.5%? I don't know, wherever we're at. Stock market's definitely gone higher than 4% this year. If the stock market starts if people can forecast it's going to lose 5-10% a year, then people would rather sit on cash. So the idea that the stock market's not losing 4 or 5% a year anymore is why people are going long. It's even with the risk of recession, it's a safer bet than any fixed income or cash trade that loses that much per year due to inflation. It's a good idea. Okay. We just chop for 5 years. Oh, I love choppy trade. It's my favorite. Okay. Elaborate on the indicator for random rolls after 2 p.m. So that's an interesting thought, is that at 2 p.m. is when FOMC is. I usually don't trade FOMC because of that reason. If I trade FOMC, it's because the market responds by moving to something that I can trade off of. If I'm very bullish for the day, if FOMC has a knee-jerk reaction that dips really hard and hits hedge pressure, I can throw in a very, very small position with a tight stop, because at 2 p.m., right, the market is random because of the options expiration. It's going to be a very volatile day, likely because this is monthly expiration week. This is a new VIX month, so VIX expires. Wait, today the third Tuesday? No, I'm sorry. VIX expires next Tuesday, as a matter of fact. This is one of those weird months where SPX expires this Friday. VIX is next Tuesday. So volatility gets an extra week because the month started on a Thursday. So VIX monthly options expire the third Wednesday of the month. And so that's next Wednesday. But the third Friday is this Friday. So the third Friday actually comes before the third Wednesday. So we're not going to have VIX mechanics. That's good. That's one less craziness. But I want to see the Fed drop us to a level that I can long off of, because if I'm a bull in the market, it's the same mechanic. I want to be long on something, but if I do trade and this light is red because it's after 2, then what does red mean according to the lights, Keith? Remember, what do we teach you guys what the lights mean? What do I do when it's red? Sit out or trade very, very small, like 10, 20% of my position. If I normally will trade 10 contracts of S&P, as example, I might buy 1 or 2 off of a Fed dip because it's red. Normally we say don't trade after 2, but we say it's red and random after 2. So the counter to a random market is just risk management. I know where I want to buy and where I want to stop, and I make sure I don't move my stop, and I use just position risk management. But it's a very, very small trade because it's after 2. Traditionally, I don't trade after Fed unless there's a reason to. I don't like to speculate how Wall Street behaves. There's just too much money moves around for you to make a really good judgment call. You're really just gambling. And if you do want to gamble, you gamble with pennies. That's my philosophy. So I'll 1 to 2 contracts, lose a couple thousand, make a couple thousand if I'm right, whatever, right? I'm never swinging for the fence, betting on FOMC, creating an effect in the market. You can't predict Wall Street's reaction to FOMC. I predicted the FOMC interest rate decision every month and got it wrong only 1 month since last summer. I've gotten it right every single month, except for one, where I said that in April or in February, I said in March we would go to 0. And then that came in at a quarter. Then I revised and said, okay, we're probably gonna be at a quarter until the middle of the summer. And then last month I said we're going to 0 this time. So this will be the second time I'm wrong if we don't go to 0 rate hike and freeze. So that being the reason I say that is that the Fed's behavior is almost entirely predictable, even to an average schmuck like myself. It's not a surprise when the Fed comes out. And very rarely does the Fed come out with something and I'm like, holy shit, I didn't see that coming. Most everyone on Wall Street has seen the Fed decision coming and it's pretty much guessed it right. A little bit of experience makes it easy to see what motivates the Fed and to call it, right? It's not hard to predict this FOMC. But what is hard is to predict how Wall Street perceives that. How is everybody else going to behave? Are bulls ready to take profit once they go to 0 rate hike and the market spikes up and the bulls finally saw that tech to move to cash so they can invest in Russell stocks? Maybe. Is that good news? Rally and then dip the market really hard and the bears finally get their out and they go on a covering spree and there's a short squeeze that rallies to the moon. Who knows? Like, the idea is that right now you have to think of the perspective of people in an upside down position or people that are FOMO and missing out on the market. What do we think they're going to do? Right now, everybody wants to be bullish this market. Every short wants to get out. So I can make a judgment call that the Fed comes out expected exactly what's going to happen. The market's going to move absolutely nowhere on that expected 0-point rate hike if I think we get it. And I think it's 50-50 that we get a quarter of a point as well. But I'm going to say we go to 0, and that's expected. The forward guidance from the press conference is really what's going to move the market. That press conference is all that matters. The unexpected part. What is Powell going to say going forward? We're going to anticipate cutting rates by the end of the year. Then everybody's going to long that probably. If he says we're still monitoring the labor market and we're still looking at inflation and we're still monitoring blah, 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 and it's expected gibberish that we always hear, same stuff, then at that point, it's the patience of everybody upside down or everybody willing to get in. What do they want to do? Bulls want to get in at a dip. Monthly maps show that. Bears want to get out. Monthlies show that. So any dip is going to get gobbled up. So now I think, okay, I want to trade Fed. What do I want to see best case scenario? Oh, hell yeah. Here we go. Ready? Jay Powell says something and market goes bloop, 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 bloop. Right? And then all of a sudden the press conference comes out and it's like good news, good news, good news. And then the market falls like that and then recovers like that. And I'm like, oh, shit. Hell yeah. Sweet. Let me long. Because there's the dip to get out. Because bears looking to get out. Monthly maps show that. So I wait and wait and wait to fall to a level. I don't chase a green. I don't buy a dip. I'm not speculating in here. I'm buying off of a hedge pressure or off of a bull zone or even in a bear zone that comes to bull zone because of DD. But I'm playing very, very, very small because it's a very crazy volatile environment. And I need to be able to hold significant amount of drawdown percent-wise without losing a lot of money if I do decide to trade Fed. Does that make sense? I will trade only off of something. So my 2 entry points on a dip today. Oh, it's 97% now. Why did I think 50-50? Somebody told me, somebody said that today. And I think I just observed that. I always thought it was like a high certainty, no hike. Thanks for letting me know. Okay, so longing from bear zone to bull zone on DD. We're supporting at hedge pressure. So I have multiple entries. And of course, it's going to be volatile and likely overshoot these levels. I have to be able to be in something small enough to hold through some volatility. Put a couple micros on a long from bear zone. If DD is at 0.9, then I may lose anything if I'm wrong. A micro is going to lose $50 every 10 points. So if I buy like 5 micros, $250 every 10, I'll lose 20 for some of the volatility. It's down $500 for the chance of getting a very good dip to buy on. So I'm gonna play like very small with some micros if I do it all. And that's how I think about Fed, right? So I only trade off of something to something. Mechanically, the S&P tanks and DD is maintaining the fort. I clearly want to get in some kind of long, knowing that we're going to end up at the bull zone, at least a touch. Then maybe I exit out of that scalp, let it resist, and then as it breaks through hedge pressure, get through on a better long once volatility's gotten away. Again, a couple micros, and then let it ride. If FOMC comes out and the market just rallies like that, well, I have no place too long off of. I just happen to miss out on that day trade. Do I think tomorrow could be bearish, even though bulls clearly want to step in by Friday? I don't think any mechanism. I look at this. Who cares what I think? This is what Wall Street's doing. I wake up and I just mirror what they're doing. I'm bullish because they're bullish. 92% is massive. Could it sell off tomorrow? Yeah. Could we sell off in the monthly expiration? Yeah. But we'll have to see the mechanic. Like if you wake up one day and you break through hedge pressure, right? Then that could be the mechanic to crash. And you need something to collapse the market if it's going to be bearish. Do I think this market's bearish at all? Well, 92% of the market cap's in a bull zone. To me, every dip is going to get bought at a bull zone. So the answer is, well, Wall Street's saying no. Let's look at a monthly map. In the future, can there be some bearishness? Well, a monthly map doesn't say anything until at least the 20th of June, which is a week from now. The bull side is getting stronger. Bear side's getting weaker with no volatility until next week. So I'm not even thinking we get volatility until, see, the space is volatility here, right? So it would be very weird for the market to become bearish until there is at least volatility that can create some dips that can trigger a bear market. But there's no volatility even over the next week. So mechanically speaking, bull zone check, very, very thin space between the two, not even volatile. So typically a market can fall because of volatility and snap right back up into place. That's volatility. So for the market to fall without volatility, you need a sentiment change. You need a genuine selling that creates volatility that continues to sell. So you need an event. So the only thing that's going to trigger a bear market against bullishness and no volatility is an event. Something needs to trigger everyone to sell. And there's no signs right now of any positional data that can cause selling except for the volatility. It's the only thing that tells me we have maybe a selling next week, selling in those weeks, because volatility can lead to selling, right? It can squeeze some longs out. But until then, it's still strong and bullish for a week. I expect any dip today to literally finish the week off there, if you want my opinion. But again, it's not investment advice. I'm just literally looking. Looks like elephant teeth. Oh yeah. I'm literally just looking at the market and the positional data. I'm not trying to guess. So this tells me that there's enough bullishness, enough bears waiting to exit over the next week that any dip, like a sell-off today, immediately is getting bought up the next day. So let's look at some high probability setups 2 or 3 days out. Let's think. If the Fed crashes hedge pressure day and the market just turns crazy strong in red, then I can't wait for tomorrow or the next day to get back in the long side. If monthly map comes out tomorrow still being strong and long off a red candle, booyah. If today falls right here, the very next day, that is still bullish. Snap right back into place. And then maybe sell that week. So down, up, down is a high probability. So I want to find either a really strong dip to buy to get back in on the long a couple days later. But I'm not gonna short any pops. If the market pops and crashes out, I'm just gonna miss out on that. There's no evidence the market's gonna sell unless it has it has a mechanism. So either Fed does it or an event creates an effect. So I need to look for the effect. The effect would be triggering margin calls, because people clearly want to cover shorts and cover long and get into longs, but they're not going to be getting into longs if longs are getting squeezed harder than people are buying. So you need margin calls. You need to break through hedge pressure. So the only event that's going to happen that creates volatility when there is none, that sells off the market when it's bullish and bears are squeezing, is an event. The only event I can think of that will surprise the market is market rallies, people start selling, and despite the buying and covering, and somehow the selling overwhelms it, creates a hedge pressure break, and then squeezes itself down. The only mechanism I can forecast, other than a surprise World War III or something, is abnormal selling off of a pop that breaks hedge pressure, and the event will be a hedge pressure break. A mechanical event. There is no fundamental event this week or positional event that creates selling. So that's the answer. You asked my question. Answer your question. That's what I think. So market rallies, and people start selling despite the buying, and it just fights its way lower and then finally breaks hedge, then falls, squeezes a bunch of these bulls here, and then falls and then squeezes. The event would be a hedge pressure break snowball that creates selling when there isn't anybody announcing they are willing to sell. Y'all got it? What is the chance price doesn't respect the monthly map lower call wall? We don't know the exact probabilities of that, but it's something when we have our back test module, be able to look at. Under conditions like when DD is 92% under a combination of these lights, we'll be able to do a back test to see how many times we've opened in bull zone and closed in bull zone under ideal rational conditions. Now, opening in bull zone, closing in bull zone before we had DD, in the 4-month back test we did back in the day, was 96.6% chance on SPY. So essentially, if you open in bull zone, you will close in the bull zone 97 out of 100 days, trading days, which just means the market doesn't really change its mind that much, which makes a lot of sense. Bulls have been bullish every day this year. That's at least 100 days. With the exception of like 1 or 2 days, DD has been down. So that metric is very strong. You know, essentially people that are longing the market will continue to long the market over quarters of time, which each quarter is 60 something trading days, right? So you usually see people will stay long for a long period of time. Bulls will just stay bulls and bears will stay bears. With the amount of money that appears in these zones is massive amounts of risk that don't shift that much. So the idea is that those 3% of the time was an event. And well, today's a possible event. So when there's not an event on the table, that's when it's really strong. The times it crashes is either a chain reaction from a hedge break or some kind of news announcement. So days like this, or the probability is much lower. But it'd be kind of like a fruitless effort to try to determine on Fed days the probability less by X amount, because the conditions of the market are different every Fed day. So it's like you can't really find like a standard to monitor people's reaction to Fed, because every single FOMC announcement, the landscape, the dynamic of the market, the economy is all in a different state. It's different reasons for things to move. So you'd have to put so many variables into a model like that. Okay, what was the inflation at the time? Oh, how many high inflation environments FOMC not raising rates created, how the bull zone wasn't respected. It's really hard to do that. So in all honesty, I just treat it like this could be one of those 3-4% days breaks, right? Today is a lot more bull bear zones than usual. Is there something to that worth noting? Yeah, it means discrepancy. It means there's a lot of people that disagree. There's a lot of people throwing in hedges that just appeared. And you see that's pretty normal leading into major events like today and monthly expiration. It's normal. To not see a clean split, it just means there's a lot of people disagreeing on where they're going to be hedging their spot. And so that just means there's potential turbulence. It's not clean. What happens if these bears go in the money and these bulls are in the money and those bears go in the money and these bulls are in the money? All these people can, it's going to get crazy in there because you're going to be striking options in, out of the money, in, out of the money, in, out of the money, right? It's not like a clean bull, clean bear zone. It's just going to show potential for volatility. As if puts go in the money, then somebody's going to have to jump in to sell. If those calls go out of the money, people long are going to trim the rate of delta. And maybe it falls here. Maybe somebody wanted to exercise their calls and long while they could get in on that dip. And it's just going to be random and choppy. That's all it tells you. As you're going to play, if you were to draw the pressures, right? Bull zone pressure, bear zone pressure, bull zone pressure. That's nice and clean. But look at this, right? You have liquidity pocket. Sorry. Illiquidity pocket, liquidity pocket. Illiquidity pocket, liquidity pocket. The market can do all kind of stuff. Does that make sense? It's going to play like ping pong inside of there. You can see that the major split, there's bullishness here, there's bearishness there. So this is like a major risk distribution. These are just people that are hedging pretty tightly on FOMC. That's pretty much what that means in monthly expiration. So in all honesty, it's just not tradable, right? Like anything down in here, it's going to be like all over the place. It's going to be really hard to trade something in there. So like obviously, I'm just going to avoid this. It's not clearly bullish or bearish. And see, so does that answer your question, Wisdom King? Makes a lot of sense, right? You get a bunch of people positioned there for different reasons, and their motivations are all different. You don't know how they're going to behave, and just treat it like it's going to be kind of choppy and random. Can I look at IWM, please? I already did. What do you want me to look about? What do you want me to look at it? I did it earlier. It's a bull long up. What would you like to know? Bull long up is very textbook. 187.5 is hedge pressure. It's very easy to see that's the break point today. What is your question about the bull long up? It's pretty tech. You should know that. It's textbook. What do you want me to say about IWM? You keep asking about it. Having trouble with half gap? What do you mean? No, no trades today. I don't open my trading platform on FOMC to make that statement. No trades today. Once we get to FOMC announcement and the press conference, I'm going to be opening up, ready to trade. You'll get back online at that point. Having trouble with half gap. Well, what would you like to know? We don't have a resilience for IWM. We should make one. But there's nothing to determine other than trying to make a guess based on S&P and NASDAQ. Russell really needs its own resilience to be able to effectively scalp the redistribution zone. It needs to have its own mechanic, separate from the S&P. So without anything to make your best guess, just use S&P resilience and NASDAQ just as a tiebreaker, saying that they're both positive, which means that they themselves are going to move likely through their box. So let's put them on the chart and say that if the index products are kind of tethered together, if the S&P were to move higher, okay, well, it's already completed that move. See, like I said, they operate independently sometimes because the Russell and the S&P are not the same. You can't, it's like I said, if you have to make an inference, you can, this is your best guess, but it's really a guess. Russell needs its own resilience to answer your question. And we don't have that. We need to build it. Makes me think about that. Please, please, please make Russell resilience. I know, we probably should make that. Wouldn't it be hard to do? Let me put in, let me see if I can't squeeze that in. We can't do MHP resilience though, because we're not set up to calculate that many hedge pressures that quickly. We need an infrastructure change. But remember back in the day, we had to, it was a year-long infrastructure change, and the data feed companies had to change how they operated and upgrade their infrastructure just for us to get, there's a little bit over 500 and something stocks and a combination overlap between NASDAQ and S&P, just to get all 500 companies in the S&P's monthly hedge pressures, the ones that have it, just to do this resilience was a massive infrastructure. To get all of the MHPs done within a minute of time, massive. So imagine doing 2,000. Or I don't know how many stocks in the Russells probably don't have options. We have to look at that number. Haven't investigated, but I'm assuming even if half, right? 1,000 stocks be wildly expensive to do an MHP resilience. We might not have the yellow one, but the white one would be pretty simple to do because it's just looking at the candle, the price data, right? Calculate 1,000 more hedge pressures within a minute of time. We'd have to create, just think about it, an army of computers 3 times large, or 2 times larger than the current size. The current size does 500. Then we need to scale to triple. And that might bog down the data providers again. They may have to scale. So one of the things about that stopped us in the tracks of originally making Russell was the MHPs having all those calculated so quickly out the door would be a very expensive task just for one number. That MHP resilience is rarely used anyways until you interact with MHP. But half gap resilience, right? The white number is calculated with open, close, and half gap. That's a very simple calculation, and we already have the ability to do so very quickly. Let me see how long it could take. He's talking to me now. But you guys understand that calculating thousands of hedge pressures additional, we're gonna have to raise your membership price. I'm just kidding, but it's a lot. We've already got our data provider, everything's stable now. I would be scared to make such a huge jump. Like just by releasing monthly hedge. Like let's make a monthly hedge resilience for Russell. We'd have to create it, test it, introduce it to small group, then medium group, then big group to make sure we don't crash these servers. We have to have a huge implementation plan for that much data crunching. But it would be worth it, right? Because it would be amazing to have a Russell DD, right? I would love to have a Russell DD. That would be the reason to do it. Not just MHP resilience, but a DD for the Russell. That'd be great, right? So let's see what he says about implementation. Basically, same count. So yeah, by my expectation, I'm talking to my head of development right now. It says it's not going to be hard to make. Like I said, it's not going to be hard to make. We already have the WAP of the ticker list, really. Yeah, we're talking about the, and it's I love my development team. He's on the same page as me. He's like, yeah, it's not gonna be hard. And I I was getting a second opinion. I knew it wasn't gonna be hard. It's like, you probably can create that calculation overnight. And obviously just throw it in the test server and test to make sure it looks correct. Test it out, then release it. It's not hard. It's a ticker list swap. So we can take the logic for S&P half cap resilience and just switch the ticker list to the Russell. So you have to make sure we can get all that data correct. The question is performance. Like, would a calculation of that magnitude impact performance? Because we have to run a new process. The calculation's simple enough. I don't know the answer to that. The performance meaning that we're having to chug out a new calculation. How much server load will that create? Will that create an effect? We're just having like a feasibility talk on that. And then of course he was the same as me. He was like, you know, MHP resilience. He's like, LOL. Like that's another year worth of work. So obviously orange resilience for IWM is a logistical nightmare because we already pressed our data providers to upgrade their stuff, essentially begging them, you need to do this. It's better for everybody in the industry for you to have this ability. And they upgraded for us, which is great. To be able to do S&P, now to be able to do that many Russell, we'd have to explore a whole nother possibility. Man, I'd love to have Russell DD. That would be the reason. Yeah, and it's not it, Carl. That's exactly right. It's the market cap values for 2,000 stocks. And it's the process. It's the continuous calculation of the process and streaming the information. What we do is when we think of an idea like this is to anticipate how many people are going to be using it, how much processing power it's going to take, how much memory it's going to take, how much database it's going to take. Will it bog down the current system? So do we have room to expand into it overnight, or do we need to upgrade the infrastructure, make it stable, then introduce calculations? We always look at it in that particular light. Like, it's essentially you want to install a new bathroom in your house. Is there room to install it? Or are you throwing your toilet in the middle of the kitchen and it's going to feel and look weird, and people are going to not want to eat in your living room because it's going to smell like shit every day. Like, the idea is the feasibility of what it's going to cost. Impact to server, impact to performance, running another process. It's another thing we have to check every day. Personnel is going to have to monitor and maintain. Ticker list going to have to be maintained. Create a web scraper to maintain that list, update the ticker list in real time so that when they switch stocks in and out of that index, they're up to date. I would... Yeah, we're talking about, will those tickers be part of the scanner? So the question is, and the logistical part we're actually discussing right now, is anything that we do put into what we call our master ticker list of what we cache on the platform will be that it will also, the impact is the scanner. So if the scanner or the ticker list grows by your own addition, if you guys go scan for a stock we've never had before, you add that one stock to the list. But if we go add 2,000 or however many non-overlapping stocks on the Russell, at least 1,000 plus, then that list becomes bigger. So the scanner it will be in the scanner list. So the question is, will scans slow down because we have that many more things to search for? So that's what we're talking about. Yeah, that's a great idea. So like I said, we think of all angles. Anytime we introduce something new, we always have the same discussion. DD was the same way. The reason why DD was immediately easy to turn on because we already had the data and I had a calculation. Okay, great. Okay, cool. The new Triple B is going to be next Tuesday. It's a Tuesday before the third Wednesday. Ooh. Okay, so should I... She said you went long on Roblox at the bottom of the bull zone. Oh, nice. You want to look at Roblox real quick? BSU. A halfway point between here, here, and here. Not bad, not bad. Good setup. I know, Russell resilience. Hey, this might be a thing next week. It's time to put it in. Now they're kind of deviating, right? It's showing how the DD bands for IWM and Russell are so different. Peter, I don't understand what you're saying. RTY doesn't have a DD band. DD bands are futures only. Let me make sure I get everybody on the same page. DD bands are futures calculations. Russell does not have a DD band. RTY does. IWM does not, sorry. Okay, so that calculation, read the notes. It should tell you that that is a conversion. Conversions, they update, they change in real time. Let me make sure it says that. Hold on. Wait, I thought I changed that note in there. Okay, when irrational. I'm going to put a note there. Okay, so the conversion number is only good for that moment in time, and it changes wildly every second. When you can, sorry, my bad. No, the conversion calculation isn't off. It changes in real time. I thought I had a note in there. Well, that's something I'm going to do right now. Okay. Let's talk about it. Let me create a cool little, let me create a tool. Hold on one second. Let me show you how this works. Watch this. Hold on one second. Don't go anywhere. All right. All right. See in the sheet right here, right? Let's go ahead and let's do this, right? So DD band is a fixed number, right? And let me just show you how sensitive it is to this. Let's say the upper DD band on RTY. And I'm going to add this note in there because the conversions, I might just take the conversions out. Okay, it's 1953.2 because it seems to be not clear that those numbers will change. Okay, so this is futures, right? RTY futures. And it is static. Okay. If I were to take, let's just do a quickie right here. All right, let's do this. Now let's get the real-time price for RTY. And let's get the actual market price. I think that's what it is. Is it X CME? Let's try it like this. Oh, I think it has to be all capital letters. There we go. Okay. Watch this, right? Okay, last price. Okay. Now let's do IWM. It's your ratio, right? Watch this. So as you see, there's a ratio between IWM and the Russell, right? Let me make sure that this is correct here. So when you convert something static to something else, as it says, it's 1914.6 or 1915.6. I think let me do Mark really quick. Okay. All right. So this is the ratio between the ratio of futures to equities. Okay. You see that? So this answer right here, if I have a static RTYDD, which is fixed futures, if I want to convert, right, to equities, convert to IWM, I must take this, since the ratio is this number divided by that the current price discrepancy between the two, the ratio is never the same. It varies slightly. So DD bands will vary slightly as well. So the converted value cross multiplying, right, equals that divided by this. And so the DD band, when you convert, is always going to dance around, as we always say that. Does that make sense? And I'm sorry I didn't explain that very well, but Peter, do you follow? Let's make that like really big. Y'all can see that. Any conversion number is going to dance around. That's a big font. 1957, 191.60, right? Every tick, 191.56. Okay, cool. And that's my bad. And I thought I put a note in there, but I'm just an idiot. Forgot. So the conversion will change in real time, which kind of asks another question is, will we get DD bands? Yes, as soon as we get futures data is the first thing we're going to do. So your DD band on SPY is going to be doing this. Every price update, DD band's going to move wherever it is, right? And maybe it's up here. So I'm just mirroring, like, every time that spreadsheet updates, your DD is going to move around based on the price discrepancy between the two on the ETF. If I had a futures chart, that DD band would be static right there, right? So the idea is, how do we display it to you? And this is the solution that we have, is we're going to create a sensitivity relationship for the updates. So see how right here, it looks like Thinkorswim RTD updates every 2 seconds, I believe. Let me double check. 1, 2, 1, 2. Looks like it's every 2 seconds it changes. Okay. So every 2 seconds, if we were to use Thinkorswim as an example, which our platform also updates every 2 seconds, coincidentally, then every 2 seconds, SPY converted DD band would move around. And that just doesn't look fun to see everything converted moving around. So the solution is each thing that dances because of a conversion value. The real solution is to have an ES chart here and a SPY chart here, or a RTY and IWM, and leave the static things there and leave the static equities things here so nothing dances around. But if you want a combined chart with all things on the chart, we have to create some logic to prevent it from just all your data moving. Because imagine going the other way. Imagine taking SPY hedge pressure and converting it to futures, right? Because this is an equities calculation converting to futures. Then on your futures chart, hedge pressure would dance around. And monthly hedge pressure would dance around. And not only that, each one of the walls would dance around. That'd be a nightmare to stare at, right? To see all of your equity stuff dancing around a futures chart. Ugh. Imagine all of these things moving. Open, close, redistribution. All of these things moving in real time. Stretching, skewing, bigger, smaller. Just because of the conversion. So it gets messy when you convert to combine it all in one. So the solution for combining is a sensitivity calculation. If this is the DD band, and this is the middle. We'll just put a 0 here. Then in the middle, the updates of when we update the converted value could be maybe every minute. So if price is hovering here, instead of it moving around every 2 seconds, it just updates once a minute. You're not close enough to interact with it, so you don't care for it to be updated in real time. As you get closer to it, it might update every 30 seconds. As you get really close to it, it might update every 10 seconds. As you get close enough to it, it might update every second or 2. Does that make sense? The bot can be incorrect as well, but in either case, that bot is really a formality to convert. I'm actually going to take out the conversions because it is confusing. To teach this as part of that, DD is a futures thing. And so I'm just going to remove it. But the sensitivity thing is how we're going to solve the problem. So like trading in the middle of the 2 DD bands, they're very rarely going to move around. So when you get closer to it, the updates will be faster. So imagine like price doing this, and then let me close out here. Imagine price in the middle starts rallying in a straight line in DD band. I'm going to move my mouse along this curve, okay? So right here, DD band is going to update every minute. And as price gets higher, it's going to update again, 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 again. So as you get close to it, it's going to start wiggling as you're landing your airplane on a moving boat. But when you're far enough away from it, it's not going to change often. It's going to update once a minute. So every minute, new value. Every minute, new value. Okay, every 30 seconds, new value. New value. 20 seconds, new value. New value. 10 seconds, new value, new value. 5 seconds, 4 seconds, 3 seconds, 2 seconds. Connected with it. Boom, done. And so when we convert hedge pressures the other way around, it'll be the same effect. Trading really far away from hedge pressure, if I was looking at the converted 436 to whatever SPY is, converting to ES, then it's not going to really update, but like once a minute, it might wiggle just a little bit. And then just a little bit. And as you're falling closer to hedge pressure, then it's going to start updating in real time. So the farther away you are from something, the less often it will update the conversion. You love that my Excel is in dark mode? That's right, baby. So hopefully you understand that mechanic. And I think that that solution that we came up with, the sensitivity based on distance, is awesome. And the way that I'm gonna create a transform. Oh, you guys, you folks that love linear algebra, I'm gonna make a transform that's gonna look just like this. The closer, if you linearly move closer to something, like a straight line, then the time updates is going to be a function. So like you have a curve, right? A parabolic curve. The first derivative of a parabola is a curve. So we're going to have to integrate. Some kind of line to create a parabolic time. So essentially, if price were to go in a straight line, then the frequency of the updates is going to look just like that. So this will be like, oops. The closer you are to price, and D will be here. The farther away you are from price, the time of update is going to look like this. So the closer you get to price, 1 over time update. So essentially, let's just flip it the other way around. 0 to D. So 0 distance away, it's going to update every 2 seconds. Actually, no, it's going to be the other way around. I drew the curve backwards. Just doing this in my head. Like that. So as you get really close to the price, the updates just decay really quick and start updating. So it's like logarithmic, and I think logarithmic will be better than a parabola anyways. So you're going to want it to look like that. So the further away you are, the update is going to be every minute. The closer you are to it, it's going to update every 2 seconds. This is distance from the value. So essentially, like, as you're moving away from it, it's going to very rapidly decay to just update once a minute. As you get close to it, that curve is going to just completely collapse and start updating 2 minutes. So as you're getting close to it, it's going to start picking up some momentum very quickly. My whole Windows is in dark mode. I love it. I do everything that way. What's your question? ETF values change a few pennies. Not a big deal. Well, not a big deal. Technically speaking, yes. But as you see, when you get close, when things are crashing and are more volatile, while it is, each update is, like you said, it's just a couple pennies off. That's correct. But if that's because right now the volatility is low. If the volatility was high, then the amount that the two stretch from each other gets a little higher. So in low volatility environments, both the RTY and the IWM are like dancing around a little bit because VIX is low, or anything that's tracking something else. There's no volatility. But as volatility goes up, they'll be out of sync even more. So this can go up or down 3-4 pennies at a time. It bounces around a lot. The higher the state of volatility, as you probably understand that as well, Carl. So because we're in a low volatile environment, yeah, it's not going to, it's the deviation's a couple pennies here and there. Let's do SPY really. I love doing this, right? Let's do ES. So the DD band, I'm just gonna make up a number for DD band on SPY, like 43.87. Okay. Oops. Oops. Well, let's not do that. Come on, Matt. Wake up. So SPY dances around 3 pennies, 2 pennies, 1 penny, 1 penny, 1 penny. So like the magnitude is one. Let's just do some quick math. Let's just estimate 2 pennies out of 400. That's 0.5%. Right? Not even 1% variation in a non-volatile environment. In a volatile environment, it can go up or down. Let me double check that. Oops. 0.01%, give or take. Small enough, but pennies matter. For that, it'll visibly move. 43.78, 43.84. So D is gonna move like in a range like this. Maybe 4 or 5 pennies, give or take, in a volatile environment. Could be 10 or 15, depends. So as S&P and futures are desperately flopping around in an illiquid environment, you might see that value dance around a little bit faster. But even so, you're right. It's a small. You're talking about pennies on something that's valued hundreds of bucks. It's actually 1/100%, not 1/10%. So your dancing around is in the magnitude of 1 to 5 pennies for the most part in a non-volatile environment. In the bear market, that volatility is really, really, really high, and that stretch can be much more massive. right now. The S&P dividing SPY by futures by SPY is 10.11. So it's not necessarily a 10 to 1. Some days it could be 9.9, 9.85. It can get pretty big when it gets volatile, for sure. Are the bots futures ED numbers accurate at least? At least I don't change from yesterday. It could just be that I made a mistake. And I'll double check that and make sure. But I'm going to remove the conversion from the bot. Because I don't want people to, despite there probably being a mistake that the numbers didn't change, that's probably my bad. Hold on. I might have copied and pasted over something. I'll go look at it, but I'm going to remove the conversion part. Okay, love you guys. I'm going to see y'all later. Call it a day. Come back. We'll come back for Fed, and we'll have another meeting, and we'll chit-chat there. Go. Sign up for Rocket Scooter. Love you guys. Thanks for supporting the platform. Bull market, still bullish. 93% DD. Monthly map, still bullish. No volatility. Market is rallying still. We called it last October. We still call it today. Like I said, putting positional data in the hands of retail trader is an edge that we've never had before. And now you see what Wall Street's doing. And really understand that I don't care about technicals and fundamentals as much as I used to. I care about seeing where everybody's positioned. If they're bullish, why wouldn't I be bullish too? Why would I think that I know something they don't? Positional data is the future of analysis. Future of market analysis is a rocket scooter. Literally the future. We look at options. They expire in the future. You can actually see people's positions in the future and where they want to be positioned. That is very powerful information, bringing power to the hands of retail traders in all environments like this recession. And the first people to call the bottom, we still call the bull market till August. There's a reason we're growing so fast. This is new data, and we're glad to give it to y'all. Thank y'all for tuning in.